Hello, everyone. It is Friday, September 16th. We're going to wrap the week today on the final bar of the S&P, the major averages continuing their push to the downside. We will look at the key measures the markets provide back to us. Also answer your questions from the final bar mailbag. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the toolkit of the technical analyst. Let's focus on key messages of price, breadth, and momentum and see what information we can dissect as we look at a number of charts together in a short time. The S&P continuing to push to the downside. The averages finishing in relative position of weakness, although a bit of a rally in the last couple hours. We'll look at the wrap the week chart and see how the last 5 days have really played out. It's been painful. We'll try to make sense of it together. We had great guests on the show this week. Had a lot of fun talking with Dave Landry and John Kosar and others. More good guests on the lineup. Next week, obviously, we have the Fed meeting on Tuesday into Wednesday. So we have a really good guest next Wednesday, the 21st. I wanted to highlight for you Sam Stovall from CFRA Research, a fantastic macro strategist. Help us make sense of what we hear from the Fed. The week after, we have Mark Chaikin, Mish Schneider, and Greg Schnell, three fantastic longtime StockCharts contributors. We'll get their take, all participating, by the way, in our upcoming ChartCon special event. That gets me to my next announcement, which is ChartCon. Go to StockCharts.com/ChartCon to sign up for our upcoming event, October 7th and 8th. Today, I wanted to highlight the fireside chats that we have going. We're sitting down with 5 fantastic emeritus members of the technical analysis and investment community: Martin Pring, Ralph Acampora, Mark Chaikin, Gaddis Rose, and John Markman. Some of them you may know. Martin Pring, for example, literally wrote the book on technical analysis, one of the most commonly referred to books on the topic, master in terms of cycles and rotations. Ralph Acampora, who literally taught Wall Street how to use technical analysis. Mark Chaikin, who created indicators like accumulation, distribution, Chaikin money flow. It's going to be a lot of fun sitting down with some of the legends in the industry, picking their brain on how they're approaching things, what they've learned over their careers, and how they're applying it to the markets today. Go to StockCharts.com/ChartCon. Members get a deeply discounted rate, so it's a really good time to be a member of the StockCharts community. Let's continue on today's show with our Wrap the Week segment. Fridays, we like to do a couple things. We'll wrap the week. We'll answer some of your questions from the mailbag. First, however, wanted to start with a poll. We asked you recently on our social media accounts and also on our live stream page at StockCharts.com, where do you see the S&P 500 index 1 month from today? We gave you 10% higher or more, at least 10% lower, or within 10% of current levels. I thought it was fascinating that 70% of you said within 10% of current levels. About 20%, 19% said 10% lower. Only 11% said 10% higher. It's interesting to think about what that means. That's obviously a pretty big range around current levels, right? I mean, think about where we're at around, give or take around 3,900, that's 400 points basically higher or lower. 4,300 would be retesting the August high. 400 points lower puts us around 3,473. That would obviously be a big drop below the June low, making a new low for the year. But 70% of you said basically, well, in the next month, we'll sort of stay in the same range. I think I would probably answer that way as well. I could see a scenario where we go much lower, right? I could see S&P 3,600, 3,200 are reasonable downside objectives if you get that downside follow through that we may be looking at going into next week around the Fed meeting. Though the least responded answer was at least 10% higher, which tells me as a contrarian, maybe think about what that scenario might look for my portfolio. Let us wrap the week now and look at what actually happened today in the markets and then connect it to some of the longer term trends. Just to touch briefly on what happened in the session today. Then we'll talk about the weekly returns. S&P down about 0.75% to 38.73. It was down around 38.40, rallied in the last hour and a half of trading. NASDAQ Composite down even more, almost 1%. The VIX actually flat from yesterday's session from Thursday, so still hanging just above 26. Now, what's interesting is when the VIX gets down to or up to 30 or higher, it often has coincided with market bottoms in 2022. When the VIX has gone down to 20, it's often been a sign of a short-term market top. We're kind of in no man's land in the middle, right? Which tells you we're not really close to either one of those if you use that sort of 2022's VIX range as a general simple system. Interest rates, actually quite a bit of chop. Long bond yields actually moving to the upside. 10-year yields, really chopping around for most of the day, but a little bit below where they were yesterday. Still around 345, which is again sort of in the upper end of the range that we've seen in 2022, and still above that 2018 high. We're at or near the highs for recent years, which is certainly noteworthy. Not much change in the U.S. dollar, to be honest with you. Interesting movements in the commodity space with some of the commodities coming off. Oil prices not really moving much to the upside, but gold and silver prices moving higher. The top performing industry group today, by the way, gold miners. How often have we seen that? The answer is not often in 2022. Gold stocks have been a tough space on a relative basis, but for one day only, starting to move to the upside. Seeing some further weakness in Ethereum prices, now below 1,500, down to 1,425 earlier in the day for Ethereum. Bitcoin still below 20,000, around 19,660. Sectors really quickly. Consumer staples, the only one in the positive, and just narrowly so. The XLP was number one, followed by real estate on the downside. The big losers were the MEI trade. That's materials, energy, and industrials, which you generally describe as, I would say, the late cyclical sectors, sort of all leading to the downside, and the rest kind of in the middle, down 0.5 to 1%. Let's go to the wrap of the week chart. So this is just a simple look at the last 5 trading days and just trying to aggregate them all in one chart. It's a great way to sort of take a step back. It's easy to get drawn into the flickering ticks of the moment-to-moment movements, and sometimes that's where you need to focus. But I find on Friday afternoon into the weekend, it's good to sort of take a step back, think about what we really learned over the last week, and let's touch on some of those themes right now. Here in black is the S&P 500, finishing the week down 4.8%. Not a great look overall. Obviously, this has been 5 tough trading days. A big part of those losses came on Tuesday's drop, which was around 4 to 5% for the major indexes. End of the week, the S&P down 4.8%. Underperforming the S&P this week, we had the NASDAQ 100 down 5.8%. Bitcoin, the worst performing of the bunch, down almost 8% for the week. Everything else outperformed the S&P in this week. Small cap stocks using the Russell 2000 ETF down 4.5%. We have emerging markets down 3.1%. Gold price is down 2.5%. That's using the GLD. The TLT is the bond ETF we tend to track, is down 1.7%. In red, we have, in brown, this is crude oil prices down 1.7. Bonds here in red down 1.1%. The only ETF in this bunch that we tracked that was positive on the week was the dollar bullish ETF UUP, which finished the week up 0.7%. So we're back to sort of a familiar theme for parts of 2022, which was the dollar up, and it's sort of the wrecking ball for risk assets. Everything else is down. Commodities down, stocks down, bonds down, dollar higher, right? More of that is how the market could certainly undercut previous lows, 3,600, even further to the downside. This sort of look every week would certainly get us there a lot quicker than we would otherwise. Let's finish off today looking at the Mindful Investor Live chart list. Let's focus on some of the messages we can get over time. I haven't updated the verbiage on some of these charts just yet, so follow along with me. But obviously a big drop on Tuesday continuing. Now, last week we had a bullish outside week, whereas where you have a wider range from the previous week, lower low, higher high, but a down close on week 1 and an up close on week 2. This week, the complete opposite, a bearish outside week. So we had a bullish outside week last week. We follow that with this week's bearish outside week, which is again a wider range, but an up close on week 1, a down close on week 2. That's a pretty negative sign going into the Fed meeting next week. My long-term model, market trend model, by the way, has been negative since early May. That's really confirmed this overall bearish, longer-term bearish environment that I believe that we're in. with the weakness that we saw earlier in the week and really continuing through Friday, the medium-term model and short-term models for me all turning negative as well. So we saw some signs of life last week, narrowly bullish on both the medium-term and short-term. This week with the weakness that we saw, all three of them. So when my market trend model is bearish on long-term, medium-term, and short-term timeframes, that tells me, generally speaking, to stay away. This is a great time to sit on your hands and be in cash, be defensive, and wait to see how this starts to play out. But certainly suggesting to me to think more defensively if I've not already been doing so. Now, interesting chart on the S&P 500. And before we go too much on that, I want to just show the candle version of the S&P chart here. Just give me a second here. We're going to show this chart here, which I call candle focus, just a candlestick version. Candle charts are really interesting. I saw Stephen Bigelow did a presentation for the CMT Association earlier this week, all about some key candle patterns that was pretty interesting. Today is what you call a hammer candle for the S&P 500. Hammer candle, visually just looks like a hammer, right? You have the open and close near the upper end of the range, limited upper shadow, and then you have a long lower shadow, meaning we opened at a certain point, we traded lower, but by the close, we're back up toward the top of the range. Think of that as something hammering out a bottom. You have a downtrend, you have a hammer candle. That suggests some short-term optimism going into next week. So it's interesting, this week, we've done two kind of very different things. We've broken down through 3,900, which I would argue is an absolutely important level. Today, today's candle is actually a short-term bearish candle, telling you the next 1 to 3 bars, most likely bouncing to the upside. So a bit of a conflict between the short-term read of the candle chart and the more of the medium-term, long-term read of the fact that we've broken down through a key support level. So how do you read this? We can get above 3,900 and stay there. This market is not horribly broken, but the breakdown through 3,900, I think, was key. We closed there on Thursday. My main takeaway is we've broken down there on Friday. I think that's weaker rather than stronger. Looking at some measures of breadth. Now, not all of these have updated just yet. We're recording this right after the close on Friday. So our databases, we're updating all the breadth and momentum data, which will be ready here shortly. But just as a quick preview, as the market moved lower in price terms, you're certainly seeing some lower movements in breadth as well. A couple things to look at. The cumulative advanced decline lines really still neutral. I think I would continue to color code these sort of orange. They're sort of chopping around quite some bit. They broke above their June highs, but didn't stay above there. They're now back below there. Probably all 4 of these go to the weekend below their 50-day moving averages. That's not a bullish sign, but it's not horribly bearish yet. We're still well above the June and July lows. So I'd have to think that's pretty positive. One interesting reading, by the way, is the percent of stocks above their 50-day moving average. On Monday, with the rally that we saw last week into the beginning of this week, this got just above 70%, around 72% of the S&P members that had regained or were above their 50-day moving average, much like the S&P did there on Friday into Monday. Now, many of them, 45% or so, were above their 50-day moving average a week ago, now below their 50-day moving average. Only 26% of the S&P remaining above the 50-day. This remains below 50% as a reading, and that's telling you overall there's cause for concern. Also concerning is the influx of new 52-week lows, right? An uptrend, a bullish phase, is usually marked by new 52-week highs and expansion in highs, a downtrend by an expansion in new 52-week lows, and that is what we're seeing right now with an expansion in new 52-week lows through the course of the week. As we go into next week, see if those red bars continue to increase. If so, that is telling you further fuel on the fire and potentially fueling further downside. Let's take a quick commercial break. We'll be back powering up your use of the StockCharts platform. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Happy Friday. Thanks for joining us every weekday after the close, but particularly on Fridays where we can look back and try to make sense of these last 5 trading days. It has been a choppy, fascinating week for sure. And as a reminder, I would encourage you to check out some of our previous conversations. Interviews this week were really, really enlightening. A couple quick announcements before we continue the program with Power Up. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show, and we'd love to feature one of your questions on Tuesday of next week, our next mailbag. You can get your questions to us via email, thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv, and we're on YouTube. Just put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Tuesday's show next week. Also, go to StockChartsTV.com. That is our on-demand platform. We have so much great content every trading day. Yesterday, I had a lot of fun recording our latest episode of The Pitch. That is available on StockCharts TV on demand. Larry Williams is working up a market outlook special for us as well. All of that available on demand at StockChartsTV.com, or on your mobile device. Just search for StockCharts TV on demand. Let's continue on today's show with our next segment, Power Up. Let's upgrade your use of the StockCharts platform in just a few moments. And here's what I would point you to today. The industry summary page is a really good function within StockCharts. I use it most trading days because it's a great way to help dig a little bit deeper into particular sectors. When I had my guest discussion earlier this week on Wednesday, I think with Julius de Kempener, we actually used that function to help prepare for the episode, talk about some and think about some of the industry groups within consumer discretionary. If you go to Charts and Tools at the top of the StockCharts website, and on the right side, you'll see the industry summary. Now, it starts with a chart view, which is pretty cool because you can go through the 11 S&P sectors. You can see charts of how some of these different industry groups have performed. And for me, I've customized these groups to use relative strength. And I would encourage you to do that because it's not just about the price movements. When you're looking at sectors and industry groups, it's all about what those groups are doing relative to the broader benchmark. So make sure you customize, as a StockCharts member, you can customize your industry summary page to make it more relevant to the time frames and to the type of work you're trying to do. What I often do, though, is switch to table view because then I can resort this table dynamically. It's great for a couple different things. Number one, if you know about the communication services sector, you know about the consumer discretionary sector, XLY, or technology, the XLK, you have to remember that those sectors are actually comprised by a number of industry groups that in a lot of ways are very, very different. So for example, if you go down to the technology space, it's not like it's just Microsoft and Apple. There are actually a bunch of different types of companies which are reflected here. You have semiconductors like AMD and MPWR and KLAC and others. You have telecom equipment names. You have software names like Microsoft. You have hardware names like Apple, renewable energy equipment like Plug Power and Enphase and solar stocks. All of these within the same sector. So one of the great things to do is resort the industry groups within the sector by their scooter ranking. What this allows you to do is show from relative strength to relative weakness. We basically percentile ranked all of the Dow industry groups, and you're putting them in descending order from strong to weak based on our proprietary measure of market trends. So when I sort the list that way within technology, renewable energy equipment, the strongest performing sector, and literally 99.9th percentile, the top performing industry group out of all of those, again, based on that proprietary trend following algorithm. The worst performing group, not surprisingly, if you've looked at the charts recently, semiconductors. And then what you can do is drill into one of those groups. This will show you all the members of the group, and you can see we cover a lot of the equity space. These are going to be the U.S. names that I'm starting with. I'm starting with the current reading, and I can sort this list on the scooter ranking as well, so I can see which individual names within that industry group are showing strength. I can also sort them inversely to see which names are struggling to perform well within that group of stocks. It is a brilliant way to take a one sector and start to drill down into the groups that comprise those sector, the stocks that comprise those groups, and really help you understand the dynamics of what is actually driving the returns in some of those ETFs. That is the industry summary page. It is a fantastic tool among many within the StockCharts platform. We need to continue on today's show and go to the Final Bar mailbag. As a reminder, we are here for your questions at all times. The Final Bar at StockCharts.com is the way to get your questions to us. And let's get to question number one. How can I see the PE ratio for the S&P 500? Great question. And there are a number of different ways we could try to do it. Here's one of the ways that I actually constructed. This is one of the charts that I use. I don't refer to valuations very often, and that's just part of how I think about the world as a technical analyst. I tend to look at charts and think and speak in the language of charting as much as possible because I'm trying to help people improve their use of technical analysis. If I'm thinking about my own portfolio, though, I think of technical analysis among other disciplines, right? It's macroeconomic analysis, it's geopolitical analysis, fundamental analysis, the companies and growth stories that tell the story of the economy. It's quantitative analysis, thinking about scans and models that help me make sense of things. And then it's obviously the technical component, which is looking at price. But when you're talking about valuations, you want to think about where the market is valued relative to where it's been. The easy way to look at the PE ratio is to create a chart using this ratio. $SPX is the price of the S&P, and then we have exclamation point GAAP-SPX, which is a ticker that tracks the earnings, the EPS on the S&P 500, and it's the GAAP earnings. A couple different ways you can look at our EPS. It's actually an infinite number of ways people have determined to look at trailing 12 months, looking at estimated EPS and all of that. The main way to do it on StockCharts is to use that index. And by looking at that ratio, I'm creating the PE ratio, currently just below 20. It's around 19.6. Now, that value could look different than where you see elsewhere because there's no one way to look at PE ratios. As much as we like to oversimplify, it's actually a little more detailed than that. So that's the best way that I've seen to show how valuations have really been coming down recently. Another really interesting way to do it is if you apply this index, exclamation point GAAP SPX 20, that basically is putting a line where a 20 PE would be on the chart. So if the S&P, the price of the S&P is touching that line, that means we're at a PE ratio of 20 using this ratio that you see below. So that's where you can see when the S&P is trading above that level of a PE of 20 or where it's trading undervalued relative to that 20 level. It's a nice way to do it. Now, we have other indexes that track other levels. Just change that last digit to like 15 or 10, and we have some other indexes that are tracked at. But I think the 20 PE is an interesting line to put on a chart of the S&P 500 to see where we're at relative to sort of that average level of valuation. Great question, by the way, and thanks for sharing it with us. Question number 2. I remember months ago, you would say during bear markets, you get violent swings to the upside, and during bull markets, you get violent swings to the downside. Is that not what's happening lately? And you mentioned that after, I think, our show on Tuesday, where I was talking a lot about how there was a big distribution day, right? And let's zoom into the last like 6 months or so we can see Tuesday's drop in a little more detail, right? Here's Tuesday's sell-off, and then I'm looking at the wrong week altogether. There's Tuesday's sell-off. That was another of the deep sell-offs that we've had in the last month, but this is the one from earlier in the week on Tuesday's session. We can see how we continue to move lower overall, making lower lows the next 3 sessions as well. And I made the comment that big distribution days like this tend to happen in bear market phases. But having said that, you're right. And that is something to absolutely remember. Just look back in May, right? Even though the market overall was in a clear distribution phase, along the way, you had some pretty big up days. I think this one, that first week in May, was one of the most notable. You know, out of nowhere, we made a new low for the year, and then we just had this big upswing. And that's what's so fascinating. That is what's so tempting about some of those big up days. Even though the market overall is in a position of weakness, at some point, particularly when you're making new lows, new buyers are compelled to come in because they see the price moving so much lower. And from a valuation perspective, stocks just look so tempting. And a lot of people will jump in and cause those big upswings. So you're absolutely right. Big up days can happen in downtrends, and big down days can certainly happen in uptrends. That's why looking at the movement in price, looking at measures of volume, looking at measures of breadth can help you try to qualify and try to infer a little bit about what it means relative to the bigger picture. But you are 100% right, which is why I think it's important on a Friday, on a weekend, wherever you have like a weekly exercise, a weekly routine of analyzing the markets, make sure you take a couple steps back from your monitor, physically and mentally, and focus on what the longer term trends have done and how they've evolved. That's a really key part of my own investment process that I start really Thursday, Friday into the weekend, is taking a step back and really thinking about how the markets have evolved. Next question. How would you use RRG and seasonality, as well as anything else, to determine the investability for semiconductors between now and year end? And you shared this RRG chart, which you created, and thanks for sending me a link to this one. You basically put some of the top semiconductor names into an RRG, which you can obviously do in the blank area there. And then you have a benchmark where you can hand enter it. You actually put the NASDAQ composite as the benchmark. It's a brilliant way to think about it. It's a great way. I shared this with Julius DeKempener just to indicate we had a question on it and to get his take on things as well. You've hit on, I think, a key point, which is the fact that if you look at that basket, that group of semiconductor stocks that you shared, you can see that AMD, out of all of them, probably the most constructive relative movement in terms of it being the only one in the improving quadrant and heading northeast in what I would call the direction of appreciation, or the direction of improvement. Compare the movement in AMD to the movement in NVIDIA, which is actually moving the completely wrong direction, right? NVIDIA obviously breaking to a new low for the year through the course of this week and showing relative weakness. Out of the semiconductor names, if you had to be in one, this would help you answer the question of where do you want to be? Now, here's the problem with that, right? It's all about the benchmark. So if I change to the S&P 500, if I change to the OEX, now I'm comparing what's happening with these semiconductor names versus the broader market. So the benchmark that you put in can, in a lot of ways, make a big difference in the RRG. Not a ton of a difference, to be honest, as I'm going through some of those different benchmarks. This is pretty consistent. But I would encourage you to think about which benchmark you're putting in there, because that can really change the configuration of these, because it's all based on relative strength. It has little to do or less to do with the absolute price movements and more about the relative price movements. So the denominator in a lot of cases can matter quite a bit. So overall, right, what's the take on AMD? Let's look at the individual chart of AMD. So if I had to own a semiconductor, something like this, yeah, I would probably put them all in a pile and find the ones that are ranked at the upper end of the list. This would be a great time, by the way, to use the industry summary page that I mentioned to you earlier. That can help to surface some of those semiconductor names that are holding up better than maybe some of the others that you may know about, like NVIDIA. The good news for AMD is it's not broken down. Well, NVIDIA has, AMD has not. It's actually holding a pretty key support level, right? Low in 2021, the low earlier this year, and where we're at right now, all just below $75 a share. We are at a key line in the sand, but similar to, I think, the challenge with gold stocks, right? Are gold stocks at an attractive level? Well, maybe if you see how low we've been relative to where we've been, the fact that we're testing all-time lows is significant, or long-term lows. But I don't like the fact that the price has gone down to be my main reason for wanting to go into a position. I would love to see this start to improve. So show some improvement, show that support has been touched and then confirmed by a rotation back to the upside. That would be my take on semiconductors, which overall, as we were talking about on the pitch earlier this week, tough space relative to others that we might be able to break down. Boy, that's it for the show. 30 minutes goes by so quickly, but we need to wrap the show. Let's go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Chart number 1, I showed in our industry summary function during our Power Up segment. You know, how do you think about the technology space and where you're seeing strength? The best performing group, based on our proprietary StockCharts technical ranking, is renewable energy equipment. It's actually the top performing group out of all of the industry groups across all 11 S&P sectors. What's interesting about this this particular stock that we're looking at Enphase, by the way, in the scooter rankings, but you can see how it's gone to a new high, broken above the November 21 high. I like the breakout and the gap above there, but I like the retest and then rotating to the upside, continuing to show strength this week. Talk about a different look than the broader S&P. The relative strength has been strong for the last 6 to 8 months, which I think is attractive as well. If there's anything that I'm concerned about here, it's something I wanted to highlight: the bearish momentum divergence, higher highs in price August into September, lower highs in momentum, which is a potential area of concern in a leading name. Chart number 2, AMD. We talked a little bit about AMD in our mailbag segment. Thanks for sharing that RRG, that relative rotation graph with semiconductor names. That was really made me think, helped me think about that space relative to some others. So thanks for that nudge, StockCharts TV viewers. But also just want to highlight, this is an interesting chart testing a long-term level of support. So a couple takeaways. Number 1, can it hold support? If so, interesting opportunity to buy at relative weakness when you think about the valuation and the performance of the stock over time. The concern I would have, though, is just because it's gone down a lot is never my favorite justification for buying something. Seeing this rotate higher, seeing the PPO or the MACD rotate higher, which would need to see a bounce in the chart first, would make me much more excited about that name. Finally, Gold. I was wondering where this was going to end out as we're going into the close, almost, but very closely. I don't know if I could call that a bullish piercing line pattern. That's a candle pattern where you have a big down candle, an up candle as bar number 2, and it closes at least 50% of the way up. I don't think I can quite give it that nod. It's so close there, but it might be interesting to watch gold going into next week as we debate inflation with the Fed. Folks, that is a wrap for the show. Thank you so much for joining us all week on StockCharts TV's Final Bar. All of our previous discussions at StockChartsTV.com. Have a fantastic weekend, and we'll see you next week.